Good evening, everyone, and welcome to our public webinar. We're doing this live. It's 25th of January at 8 p.m. And we have more than 1,000 participants attending today from both Zoom and Facebook platforms. The bandwidth might be stretched because of the volume of participants. So we do apologize in advance for any lag or delay that you may experience. My name is Ibrahim Sani, and I'll be your host and moderator for this evening. Over the next 1.5 hours, we're going to be going through some of the issues surrounding the market, what the outlook is going to be like, and of course, try to see how we can navigate across all the hurdles and challenges that lie within. It's hard to believe that we're almost at the end of January, and in the past week, if the past few weeks are of any indication, it's going to be a wild ride for 2022. Global investors, retail, institutional as well, are getting a sense of deja vu all over again as Omicron forces are renewed across the globe. Lockdowns are being instated, reinstated many times over. And because of that, we are also very nervous about how COVID-19 is going to pan out. Markets is also contending with higher interest rates, as well as the possibility that central banks like the Fed is going to seek to tamp down inflation by tightening aggressively, with at least 3 rate hikes priced in by Fed. Could we see echoes of a taper tantrum like what we saw in 2013? To help us understand and answer some of the questions today, I'm joined by the key investment team panel, a very illustrious panel actually to be speaking of, from Affin Hwang Asset Management. They are David Ng, the Deputy MD and CIO, Esther, the Senior Director at Fixed Income, and Peng, Senior Director at Equities. We've got both debt and equity joining us. And together we shall unpack the outlook for this year and try to see and pick their brains into how they are thinking about for this market for this year. Before we get started, let's begin with a quick poll as a warm-up, and again to set the tone and to let other people come into the conversation. The question is, how do you think global markets will fare in 2022? Do you think that it'll get better or worse, or no idea? It says here, host and panelists can't vote. Unfortunately, I would like to vote actually, but I can't. So what do? I guess I have to move along then. In the meantime, here are some reminders to improve the internet connection. We do recommend that you close access windows and apps and try to switch off notifications as well to remove distractions. There are also a Q&A session at the end of today's forum. Again, a reminder that this is live. We're doing this in real time. It's 8:03, 25th of January. So we are looking forward to some of your questions. Feel free to type in your questions, submit them via the Zoom's Q&A box. You can also click to upvote questions at the top. And for those tuning in from Facebook, you can type in your questions in the comment box, as well as we will observe and try to get them answered. Lastly, we'd like to make a disclaimer to all our guests. Please note that today's forum and all related content is for discussion purposes only. Nothing from this forum is intended to be or shall be construed as an offer to buy or sell, or is it an invitation to subscribe to any securities or investment. Please, we advise you to do your own research and to speak to a qualified investment professional before making any decision to invest. And now that we have all that out of the way, let's try to bring up the poll results. You have the poll results. This is not convincing, isn't it? 44% of you feel better. That means more than half will feel that you either have no idea or worse, which is a good time to talk about things, I suppose, because if you really think it's about the things are about to get worse, or if you have no idea, this would be the panel for you. And for sanity check, the 44% of you who thinks that it'll be better, again, it's a good time to do a sanity check to see if your observations actually tally with the expected I guess observations from our analyst. All right, now moving along, let's jump straight into our speakers. Let's start with David Ng. We know that the outlook for 2020 has been described in a lot of ways, but the common refrain that keeps on going around and around is that this is a year of transition of sorts. So maybe to begin today's roundtable discussion, do you think this is a kind of a true and fair kind of reflection of how things are? How can investors expect this year is going to shape up, David?
Okay. Hi, Ibrahim, and thank you all for dialing in this evening. To your question about 2022, yes, I think you rightly couched it using the term transition. It is a year of transitions, and not just one, but I think multiple transitions. The first transition that comes to mind is that the global economy is transitioning from what we saw last year, which was, I would categorize it as a recovery boom phase, into what is termed as a slower growth phase. So remember, slower growth means the growth rate is decelerating. It does not mean the growth rate is turning negative. So that's a key difference there. And you have to think back to 2020, to what happened in 2020, which led to that strong recovery boom that we saw in 2021. Remember when COVID hit, a lot of governments around the world and central banks, but in particular the US, they implemented or injected extremely large fiscal and monetary stimulus to offset the impact of lockdowns on the real economy. Right? And this helped the economy recover very strongly. But more than that, it led to very strong corporate earnings, ample liquidity, and that led to markets, and not just markets, but all sorts of asset classes rising very sharply over the past couple of years after the COVID sell-off. And logically, purely due to base effects, growth will slow down this year, right? Very sharp recovery last year, year-on-year base effects, growth will slow down, stabilize this year, what I would consider steady state growth. So that's the first transition, Ibrahim. The second one, which is more important and what's currently affecting markets, is this transition from easy monetary policy, monetary easing, to monetary tightening. And what do I mean by this? Ultimately, we all know that of all the central banks in the world, it's the Federal Reserve that matters most. And the Federal Reserve has communicated and indicated that they are looking to, number one, hike interest rates, and number two, to engage in tapering, which is essentially reducing the purchase of treasuries and I believe mortgage-backed securities in the market. So tapering has actually commenced. They've guided for January and February this year. And if they continue at this pace, then by March, April, it comes to a halt. So the Fed will no longer be out there buying treasuries and mortgage-backed securities. And really, this is in response to elevated inflation pressures and to the Fed's mind, and from the data that we've seen, rapidly strengthening labor market. So from the Fed's perspective, they think that the economy is able to stand on its own 2 feet already and no longer needs increasing amounts of policy support. And the most crucial factor in all of this, Ibrahim, is if history is any guide, the months leading up to the first rate hike tends to lead to higher volatility in financial markets, which is clearly what we're seeing now. We're seeing expensive growth stocks being sold off, more pronounced in the unprofitable growth names, the thematic names, because those stocks rely on rates staying low in order to justify their valuation. So in conclusion, I think in the initial months of this year, markets will be volatile, expensive names will get sold off, because some froth needs to be taken out of the market. But if the economy stays healthy and earnings come through, which is what consensus is expecting, then the markets could still deliver positive returns as we move through the rest of the year.
Okay, David, we have to put a pin on it. I want to move to fixed income because the specter of inflation, as David mentioned, continues to haunt investors, I suppose, for this year. So whether it is a transitory, or persistent environment, there are different opinion camps on where inflation is headed. Which side are you on this, Esther?
Good evening, Ibrahim, and everyone who is joining us. Thank you so much. Okay, this is obviously a very hot topic and debate, throughout last year, and continuing on in 2022. whether inflation is more sticky or is transitory. If you remember, I think the Federal Reserve last year has been using the word transitory to guide the market, but back in December, they decided to drop the word transitory, as the chairman, Jerome Powell, said that, the word no longer represent what they want to communicate to the market. So I think there was a lot of confusion about what the word transitory means as well. For most people, they look at transitory means that inflation is going to be high for a short term and it will come down sharply. And the Fed felt that, the inflation numbers might stay high for longer. And we have seen that, inflation in end of last year in the US has hit 7%. And hence you are seeing that sell-off in the markets. I think in Affin Hwang, we are in a camp that inflation is likely to taper off towards the second half of this year, because a lot of this high inflation has been caused by the post-pandemic effects, as well as supply chain bottleneck that we've seen globally. And as David alluded earlier, we do expect growth to slow down in 2022 from a very high recovery last year. So with slowing demand and easing of supply chain, bottlenecks in the later part of this year, we think that inflation should taper down, but it could take a little while longer. So I think in first quarter, we should continue to still see high inflation numbers, and it should roll over in the second half of the year.
Very interesting, because now I want to pull back to Malaysia. As we all know, Malaysia was the second worst performing equities market in Asia after Hong Kong because of a slew of concerns from fresh lockdowns, increasing political risk, and it seems like no amount of elections is going to reduce the political risk at the same time. There are issues or concerns of new taxes under budget 2022 that was announced by the finance minister last year. And because of all this and many others, by the way, volatility is still considered, I guess, peaking. How would you sum up 2021? And do you feel that Bursa has reached its bottom, or is there still a trapdoor left to be opened here?
Hi, good evening. Let me answer that question. I think if you look into 2021 market performance, I think right up to the budget, it was actually doing quite well. If you take out the growth sector, that basically distorted most of the market index movement. I think if you speak to most private funds, most people are doing about double-digit returns, driven by technology, driven by banks. But the thing that really took the breath out of the market was the prosperity tax, the Cukai Makmur, which effectively tried to raise about 5 to 6 billion, but within 2 weeks, it wiped out about 30-40 billion of market value. So as you know, I think stock markets are priced off growth, and the Cukai Makmur basically removed a lot of growth prospects going into 2022, and the market reacted immediately. So it ended badly towards the fourth quarter, and that's where we stand. You can look at it in terms of silver lining is that a lot of bad news has been factored in last year. I think foreigners were net selling, the local funds were net selling 12 billion. So most of the funds positioning have done a lot of selling. And in terms of political news, in terms of the prosperity tax, in terms of the lack of growth, most of it has been priced in. What the market is reacting to now is what David was talking about, which is a change in monetary policy, which is taking out some of the growth names and risk assets. So we don't think there's a lot of downside for Malaysian market because it's already cheap. We've been seeing 7 or 8 years of foreign selling. We saw very heavy selling by local funds, but we do not see a lot of catalysts to drive it higher either. So we don't think there's a lot of downside for Malaysian market, in short.
It's very important for us to touch on that as well, because Gan, you were talking about the issue of currency and strengthening of the US dollar. Maybe I can push this back to David. The Fed, as you were talking about earlier, is embarking on a tightening cycle to tamp up or to tamp down inflation. And there are concerns that a stronger US dollar could make Asia more vulnerable to outflows than before. Do you feel that there are more pain ahead of Asia? And what about Malaysia?
Ibrahim, very valid question. On paper, the answer is yes. What we learned in school, in college, rising US rates tends to lead to a stronger US dollar. But as I mentioned earlier, this is a year of transitions, and I think it's very difficult to have a static 12-month view. So in the nearer term, I would agree with that, with the view that the US dollar remains strong. Mind you, the US dollar has appreciated over the past few months. And by all accounts, the US dollar from a valuation perspective is actually expensive. But given the specter of rate hikes, yes, that should underpin the US dollar. The other way to look at how currencies trade against each other is also to look at the interest rate differential. So as US interest rates rise, the attraction of flows into US dollar remains supported. So that's the first thing I would like to say. But this is a shorter term view. Currencies are notoriously hard to forecast. And things could change, right? Number one, as we move through the year and what we mentioned earlier, we are in the camp that I don't want to use the word transitory anymore because the Fed has dropped it. But I am of the view that inflation will moderate as we move through the rest of the year. As Esther mentioned, as demand conditions normalize. During the lockdowns, a lot of people couldn't go out, especially in the US. So they consumed a lot of goods. And added to that, there was a supply chain disruptions. And that led to prices rising. Some of you would be aware, secondhand car prices rose markedly in the US because there was not enough new cars to buy. And people were in the market buying secondhand cars. So a lot of these factors that led to high inflation last year are transient. There are some which are stickier. The two that come to mind would be wages. We're seeing, given the low unemployment rate in the US, wages are rising. The second one that comes to mind is shelter, because there is very low inventory of housing, and therefore rents and home prices have risen. So those are the stickier parts of inflation. But as inflation, in spite of all this, we think inflation will moderate because it's a year-on-year base effect that starts kicking in from the second quarter of 2022. And if demand growth slows down, for every action, there is a reaction. George Soros calls it theory of reflexivity. So as mortgage rates rise, house prices come down, you see lumber prices coming down. All these taken together leads to our view that inflation will moderate. And if that is the case, the Fed may actually tone down its hawkish rhetoric. And remember, the markets are always efficient in pricing news. And earlier you mentioned, Ibrahim, that the markets are expecting 3 rate hikes from the Fed this year. In fact, it's 4. If you look at the rates futures market, it's already priced in 4 rate hikes. So I would argue that a lot of that is in the price already. And if there's a change in tone by the Fed, combined with the possibility that China recovers, and China is very important for the rest of Asia, then we could see towards the second half of the year where the US dollar actually depreciates against Asian currencies. The other thing we look at as far as the impact on markets is concerned, we like to look at the vulnerability of Asian markets. Fundamentally, this tightening, or QT, we call it quantitative tightening, it has 2 main channels of impact for Asian stocks or Asian markets, right? Number one, I mentioned higher policy rates or yields lead to pressure on valuations, right? 2, that could lead to capital outflows because money wants to flow to where interest rates are higher, which would be the US as it continues to raise interest rates. But by and large, just looking at the past 2 episodes, 2013, the taper tantrum, 2017 to 19, when the Fed also embarked on the tightening cycle, I think Asian economies are in a much better position to withstand this tightening cycle that we are seeing from the Fed. And we look at various measures, current account deficits, FX reserves, foreign ownership, etc. So in the near term, yes, US dollar strength, but things could change as we move through the year.
Still sticking with the Fed, Esther, maybe I can toss this question to you because the Fed has signaled that it plans to accelerate its tapering of bond purchases that would pave way for a possible 3 rate hikes for this year. Has this been well priced in and communicated by the Fed to the market, or is there a risk of markets still throwing some form of a tantrum right now?
Yeah, that's a good question. In fact, the Fed has not hiked any rates as of now, but the fixed income market, the US Treasury, as well as global interest rates has been on the rise. In fact, since August 2020, right? That's more than a year ago. And hence you see that for fixed income funds, last year has been a very challenging year across all the fixed income asset class due to the expectation that the Federal Reserve will have to hike interest rates. So I would say that the market has already priced in fact, 4 rate hikes for this year, given how much bond yields have moved. Just to share, the 10 years US Treasury today stand at around 1.7%. It has risen tremendously from 0.5% back in August 2020. So that is a 150 basis point move before the Federal Reserve even lifted their interest rates, in 2022. So what I'm trying to say is that a lot of this has been priced in. Would the market, be selling off more from here? I think that's the question we need to ask. How much more can interest rates go up from here? We think that given that this round, the Federal Reserve is guiding that they want to tighten the balance sheet or reduce the balance sheet faster compared to the previous round when they reduced their QE program. I think there's still some room for interest rates to move higher. But I think the upside of interest rate from here is likely to be around 30 to 50 basis points, and we should see markets stabilize from there. Yeah, so I think this year will be a year. Sorry,
Esther, I wanna still stick with you. Last week we saw the report by The Edge stating that Bank Negara plans to raise OPR by 100 basis points between 2022 and 2023. Maybe you can give your house view on what the situation is, at least for 2022, for Malaysia OPR.
Yeah. So the recent Bank Negara meeting, I think they remain to be a little bit more dovish in the sense that they are still prioritizing growth, the recovery in Malaysia. So I think Bank Negara tend to move in a slower manner compared to the Federal Reserve. Bank Negara tend to be more cautious in hiking rates. And I think this year, we think that Bank Negara is likely to hike interest rates 2 times and another 2 times in 2023. That's our house view. And this is a slower pace compared to the Federal Reserve, but we think they will hike rates by 4 times this year. Yeah, so Bank Negara is likely to be more tapered in their view. One of the reasons is because inflation in Malaysia is not a big concern. This year, the Ministry of Finance and Bank Negara expect inflation to be around 2.5%, which is still relatively low compared to the inflation numbers we are seeing in some of the developed markets and some of the higher, emerging markets like in Latin America. So in Asia, I think a lot of the central banks will be more cautious to hike rates. Another reason is, of course, our economy is closely linked to China. And with the slowdown in China's growth, I think we will be more cautious on that front.
Okay. We are doing this live. It's 8:25 by my count. I will move on to Gan. But before that, we have had a few questions coming in. So keep the questions coming in. As I see the trend, the theme is stacking up, I will group some of the questions together so that we don't have any repetitive questions being asked. Gan, there are some early linings, some early silver linings for Malaysia. The government has made several U-turns on its policies, including the reinstating the exemption on foreign sourced income, as well as stamp duty cap. Do you think that this is a sign of optimism? And perhaps do you feel that there would be any other catalysts that lie ahead for Malaysia for this year?
Okay, I think the main thing that took the breath out of the market remains the prosperity tax. If there can be a U-turn on that, I think you will see a decent pop in the stock market for 3 to 4% at least. In terms of stamp duty, in terms of the dividend policy, is not very significant. It's about 400 million, which is a drop in the ocean for the market. What market participants are hoping for is an election that leads to a stronger coalition party or something more dominant party, as opposed to a very loose coalition that we are seeing for the last 2-3 years. The issue is that because of weak coalition politics, it has led to a lot of socialistic policies that is ultimately not good for the stock market. You cannot create wealth by spreading it around. It basically detracts from the wealth creation of the stock market. So that's what participants are hoping for in the potential general election in third quarter of this year.
Yeah, so that's a view that you want to stick on, yeah? Third quarter general election. I think many would agree. I personally would agree actually on that timeline as well. But since we're on this topic, there's a question by Thomas. And I don't know who should take this question, so I'll just leave it to the panelists to discuss. Do you see any impact from tensions simmering between US and Russia? Also, any risk of a trade war between the US and China again? So generally speaking, it's geopolitics all over again. If people are quite unfamiliar with the issue, a few NATO coalition countries have been sending warships, planes, sorties to the Ukrainian border. It's building up. Also, tensions are rising in China. So yeah, anyone from the panel who wants to address the question by Thomas here?
Okay, I will attempt to answer the question. I'm no geopolitical expert. We do have a self-professed expert in the company, but he's not on this call. As far as Russia invading Ukraine is concerned, we do subscribe to independent publications, and they've got their geopolitical strategy. And their strategist thinks that there is a 50% chance of Russia invading Ukraine, or at least the eastern part of Ukraine, which to Russia is actually part of Russia. Right? But the time frame of that invasion, if I remember correctly, he's putting it at between 12 to 36 months. So it's not imminent, even though they, as you pointed out, they have, I think they've got about 100,000 soldiers now amassed along the border of Russia and Ukraine. Anyway, regardless of if or when that happens, if it happens, then yeah, definitely it will send shockwaves through the market. In fact, the market's already kind of pricing some of this in. Of course, the key issue would be on energy, right? Given Europe is highly dependent on Russia for its gas sources. And again, if energy prices spike up further from here, it will then lead to further noises on inflation rising and leading to that potential of, hey, look, with the Fed and other central banks turn even more hawkish than what is currently priced in the market. And that can only be negative for risk assets. Now, back to our in-house expert's view, he ascribes the probability at 10%. He thinks that why Russia is doing this is because they are a little bit upset that Germany has reneged on the opening of the Nord Stream 2 pipeline. It was agreed upon by Merkel, the outgoing German prime minister, but given the upcoming change in government led by a different party, more green, they have decided not to proceed with it. And from Putin's perspective, look, this is something that we've already signed on. The pipeline is built; it's just waiting to be turned on. So if he or if both parties, Western Europe or developed Europe and Russia, can come to an agreement to honor that agreement, I think the probability of a Russian invasion of Ukraine would subside dramatically, because Russia really has, I'm trying to come up with a polite phrase, but Russia...
It's okay, we're in good company. You can be impolite.
Russia does have a strong bargaining power, given that Western Europe is reliant on Russia for energy. The other point to highlight also is that Ukraine is not part of NATO, right? So the NATO alliance, yes, I know Americans have sent some soldiers, etc., but I'm not sure whether the rest of Europe and NATO allies would really want to wage a full-scale war with Russia. I mean, they can say, look, Ukraine, you're not part of us, you're not our member. So yes, we will just saber rattle. We will try to get you to the negotiating table, threaten you with economic sanctions. So I think economic sanctions is probably the way to go if the invasion does happen.
Okay, I still want to stick with you, David, because since we're talking about geopolitics here, we need to move to China, because throughout 2021, the stock market there was battered by regulatory headwinds. Some sectors, including the tech sector, is still going through some clampdown. Anywhere from Ant Group, Jack Ma, you name it. Every single step of the way, Tencent, every step of the way, there seems to be greater regulatory headwinds and clampdown by the government. Do you feel that there are signs now, a shift in policy tone with the government turning more pro-growth? Or do you feel that this whole clamping down by regulatory headwinds is going to continue? And do you feel that is it the recovery that is happening right now in China?
Okay. I think if we take a step back, and Gan mentioned about Cukai Makmur or prosperity tax in Malaysia, I think what drove the Chinese government to implement or introduce all these regulatory measures in China is because of their objective to achieve common prosperity. So they didn't want data to be concentrated in the hands of only a few large private enterprises. They did not want wealth to be concentrated in the hands of only a few private entrepreneurs, but they believe, going back to their socialist roots, they believe that wealth should be spread more equally. So I think this is what led to the introduction of all these regulations. But as you rightly alluded to, Ibrahim, I think that again, it depends on which sectors, but I think for the internet sector, the big hits were taken last year. And if you are a corporate, you're an entrepreneur in China, you can only toe the line. There's no room. It's not like in the US where you can challenge decisions in court. If you want to exist and continue to exist in China, you have to toe the line. And a lot of these internet companies have already either tweaked their business models. A lot of them have had to voluntarily contribute to money to be spread out amongst various segments of society. So a lot of donations or contributions have been made in order to appease the government and to essentially get back on the good side of the government. I'm not saying there's not going to be any other regulatory measures, but I think whatever subsequent ones that come in would be less intrusive in nature. And on China, on the recovery, yes, we have started to see at the margin some loosening measures, not just toning down of regulatory measures, but actual loosening. So in the past couple of weeks, they have reduced interest rates in various forms, lending rates, policy rates. The other thing that we've seen is a front loading of local government bond issuances, right? So the total size of bond issuances this year is expected to be the same compared to last year, but they're trying to front load it. So hopefully you can then see this money flow into the real economy to help to arrest the decline and this current gloomy outlook on China. Property sector is the other big one, and Esther perhaps can share more about it. But property is a big segment of the Chinese economy. If you look at property prices nationwide, they have recorded 4 consecutive months of negative growth. and China is under pressure to stabilize price expectations. So at the margin, China is doing that. They have not resorted to big bang announcements. And I've not seen any official come out to say, look, we are going to turn on the spigots in a big way. Most of these are just talks and rumors. But at the margin, little things like reducing interest rates. And I think there's going to be more further reductions in the coming months. For the property sector, mortgage applications are being approved a lot faster. We have seen in the past few weeks as well, and Esther can verify this. We've seen selected developers being able to tap the bond market again, and some M&As, mergers and acquisitions, are being initiated as well. So given that the sector is highly regulated, definitely all these things are happening with the blessings or perhaps with the encouragement from the central government. The other point I want to highlight about China is a measure that a lot of investors look at. It's called the credit impulse. And we've seen the bottoming of this credit impulse. Hopefully it continues to pick up and lead to a better year for China.
David, a quick one before we move to Esther. There's a question from SP asking, what are your views on China A share market?
Okay, broadly speaking, okay, let me just backtrack a little bit. Consensus has it that the Chinese A share market would do better, but sometimes consensus looks in the rearview mirror. But let me just share with you why consensus thinks so. Consensus thinks so because the A share market is less exposed to the internet space that's only on the H shares. The A share market also is home to a lot of companies that are in industries which the Chinese government is encouraging for China to be more self-sufficient and reliant. So it could be in the form of machinery companies, semiconductor companies, because China long-term view, and I'm sure most of us here are aware, they want to reduce their reliance on technological imports and IP and know-how from the West. Over the past couple of years, they've been subjected to sanctions, and companies like Huawei were banned from purchasing some of their input materials from the US. So China clearly wants to move in that direction, and a lot of these companies are listed on the A share market. So that's a consensus view. I think there is, well, the start of the year has shown consensus to be wrong so far, because the A share market is actually down on last count about 4-5%, whereas the H share market is up. It was up about 5%, but I think after today it's probably up about 3+%, because the H share market has been very oversold. Regulatory pressures or the intensity of regulations on the sector should have peaked, and I won't be surprised if the H shares also perform this year.
Okay, still sticking with China, but we move to the bond market. Esther, we know that last year has been a turbulent year for the China's bond market as the Evergrande debt saga continues to unravel. And the property sector, as David rightly pointed out, it's a big deal there, but it's now seeing a string of defaults across various developers, across various cities, across various sizes of development projects. And of course, all this begs the question, are there signs of stabilization, or are the fundamentals still very weak for the China's bond market?
Yeah, I think last year, if you look at the China high yield bond market, it has corrected more than 20%. And in fact, in January, we have seen the sharpest sell-off in the China property space, when multiple, of the high yield bonds or even investment grade bonds were downgraded, and we saw a few defaults as well in the China space. So perhaps just moving back a little bit about what happened in the China property space. It started back in August 2020, when the central government introduced some measures called the 3 red lines to try to curb the growing debt of a lot of these property developers. So, these property developers, they were doing very well, but a lot of their growth were driven by debt. They've been growing by borrowing a lot, and the China government is concerned whether this is sustainable. And some of these companies are not disciplined, and their debt level has gone up to a level where it is worrying. So Evergrande is definitely on top of everyone's mind because it is like the world's most indebted company with over 300 billion US dollar of debt, right? That's like the whole of the, more than the Malaysian reserve.
AKPK can't help them, put it that way.
Yes. So when they introduce this, what it means is that for companies that do not meet the 3 requirements, they are not allowed to borrow more, right? And for every developers that meet one of the 3, they can borrow 5% growth per annum. And that has actually made a lot of these property developers, in terms of servicing their debt, especially for Evergrande. So when Evergrande started to have problems at that point in time, back in 2021, I think the market thought that there's no contagion, that this problem is mainly for the very weak property developers like Evergrande. And I think the market do expect Evergrande to default, along with some of the weaker names like Kaiser and Pantasia. However, I think that quickly unraveled, where I think consumers in China started to get very concerned. If you are a consumer in, trying to buy a property in China and you are worried about the developer going under, you are unlikely to buy a property. And hence we see a slowdown in sales in China. And that has an impact to the other developers as well, where the whole sector started to slow down. And with the downgrades and the very tight liquidity in the bond market, a lot of these developers are then unable to come to the bond market to reissue or roll over their debt. So it has become a liquidity crunch. And I think a lot of the cash that the developer have, banks started to tighten as well, asking the developers to put in more money that they have in the escrow accounts to make sure that they are able to complete their projects. So a lot of this cash has been used to prioritize development and delivery of projects, and not enough cash to roll over their debt. And that kind of unraveled very quickly in January, where we saw one of the largest names like Shimao, supposedly quite a strong investment grade name, was downgraded from BBB to a single B in a matter of 2 months. And I think that caused major concern and a really sharp sell-off in the market. And I think we were surprised that the China government took so long to stabilize the market. But thankfully, we saw since last week, they did start to ease policies by cutting interest rates, lending rates, as well as policy rates. And I think there will be more to come to support the property sector. So since then, we have seen a relatively sharp recovery in the property space. And we think that as we go into Chinese New Year, it's a very important period for the property market in China, because this is where every year people go back to their hometown and property sales is the highest during Chinese New Year. Yeah, so to answer your question, I think we are seeing some sign of stabilization. But having said that, I think there will still be more defaults to come as the government is willing to let go of some of the weaker developers as well. So what are we looking out for is we think that there'll be more debt exchange and asset sales, and it will be a very slow recovery for a lot of these property developers to regain back their investment grade rating. It will probably take them a few years for those who make it, to come back to the market.
Do you think that this will persist throughout the year, or eventually will be resolved sometime this year?
Yeah, so I think for developers that survive this, they will have a sharp recovery in the second half of the year because their bond yields have been sold off too sharply. A lot of these names, they are trading at over 20% yield, right? Given the sharp sell-off that we saw in January. And we think that this year, a lot of these names, we are seeing some opportunities for the stronger names. But you have to be very careful because out of 50 names, perhaps you will see about 30 names will survive, and you'll see some defaults or debt restructuring happening down the road as well.
Still, again, with Esther, I want to tie in with the local outlook on the local bond market, because there's a few questions still on the bond market. I want to pick your brains on this whole institutional support being expected to be better this year with the return of EPF as a market participant. Do you feel that this is the situation right now for the local bond market?
Yeah, I think last year, as you know, the domestic bond market is highly institutionalized. 90% of the trading of bonds in Malaysia are driven by pension funds, insurance, asset managers like ourselves. And EPF is one of the major player and investor in the space. And we have seen a lot of withdrawal from EPF, and hence they are keeping that buffer to meet those redemptions. And last year we saw local domestic bonds had a tough time. In fact, I think the domestic market has not had a negative year for many, many years. And last year was the first year where the ringgit bond market had a negative 1 to 2% returns. We are definitely more bullish about the domestic bond market this year, given that if EPF is back in the picture. But it is not a smooth sailing, easy road, because we are faced with rising interest rates globally as well as in Malaysia. And hence, in at least the first half of the year, we are staying cautious. But I think for us as long-term investors, like many of you, we do look forward to higher interest rates, because it has been also very challenging if you are an investor trying to get yields. Bond yields has been extremely low in the last 2 years. And now we are seeing that reversal. It's a year of transition, but I think by second half of the year and in 2023, portfolio yields and bond yields will be a lot more attractive for investors to look at.
Okay, still within the local bond market, still sorry, David and Gad, but there's a bunch of questions coming in. This one is from Gerald. Gerald is asking, we've seen Malaysian sovereign credit rating deteriorating since 2020, including Fitch and S&P. Do you think it could fall further, and how does this impact income from bond? That last bit was mine. Yeah.
Okay. Yeah, I think talking about the rating outlook, we are not alone because of the pandemic. A lot of governments have to, do stimulus, fiscal stimulus to help the economy to recover. So Malaysia has to do what it needs to do as well to spend money to help the economy. I don't think Malaysia will be downgraded in the next 1 or 2 years if we manage our finances and the fiscal position, because a lot of these rating agencies do give time and they look at the outlook on a medium-term basis. So I think this year, we also believe that the GDP growth in Malaysia is likely to hit around 5.5% to 6%, right? Although our fiscal deficit will remain high this year, we think around 6% to 6.5%. That should come down in 2023 and 2024. So yeah, and also to put it in perspective, Malaysia is still a single A rated country, and our bond yields is still relatively attractive. For example, our 10 years MGS, the government bond, is today trading at 3.7%. If you compare that to other single A countries like Korea or even triple B countries like Thailand, 10-year bond yields in those countries are giving you less than 2% returns. So I think our bond market is still relatively high yield. And even if we are faced with a 1-notch downgrade to a triple B plus, we do not think the impact on bonds is going to be that significant.
Dan, there's a question from Hassan here asking, are you expecting a surge in FDI's flow into Malaysia in 2022 particularly after what Esther was mentioning just now?
I think for FDI, which is the real investment, Malaysia has been enjoying very good flows over the last couple of years, and the approval rate continues to be very strong. You've seen technology names like Intel proposing to invest about 20 billion into Malaysia. So FDI is not an issue, especially on the manufacturing space and the technology space. Remains very strong. What we are not seeing is portfolio flows. Portfolio flows continue to flow out of Malaysia. It's been flowing out for the last 7 out of 8 years. Yep.
Throughout 2021, foreign investors have dumped local shares on the back of various factors like politics and, of course, ESG. There's a question here on ESG as well, but I'll ask that later. My own question is this. It was mainly retail and local institutional investors who were net buyers. Could we see the tide turn in terms of foreign inflows for this year? I know you touched a little bit just now. If not, do you think Bursa can still remain vibrant with just local participation?
I think, let's address the issue of foreign investors. When foreigners buy into a country or a stock, they are basically looking for a growth story. And Malaysia, unfortunately, has not really been providing that vibrancy or that catalyst that investors look for. And as a marketplace, it's become actually very small within the Asia Pacific space. So that's why we see continued outflow of the foreign funds. But having said that, Malaysia traditionally has been dominated by local money, local funds, local retail money, and government funds. They account for 60-70% of the market activity. So we can survive, and we have done relatively okay just using domestic liquidity. So it can be done, and it will probably be better this year than last year because, as what Esther said, there will be less EPF withdrawals this year. There should be more natural buying by the large pension fund. Yep.
Yeah, that's another whole story altogether about the EPF low withdrawals. We'll get the EPF folks to come in on this conversation eventually. But for now, we'll still stick with equities. There's a question here. I don't have the name. I don't know whether it was asked by an anonymous person or it was copied without the name. ESG was blamed as the reason of the poor performance of Malaysian plantation and oil stocks, but energy and material names performed well in the US. How do you think this is better explained, Gan?
That's a good question.
Tough, huh?
Yeah, I don't think investors.
That story, is it what you're talking about? That whole growth story?
Yeah, I don't think the investors compare the Malaysian names to the US names from a ESG perspective. Ultimately, whether the stock performance, whether there's growth or not. I think you can see I'll give you an example. I think a very recent listing coming up. It's a farming company. As you know, farming business has a lot of environmental impact. But because it's quite a rare company and because the growth prospects is quite strong, there are just a lot of investors clamoring for this position. So as long as it can provide the growth, I think generally the stock can still perform in the medium term, unless the E part of it is very structural, like the plantation names.
It's 8:55. I think we can move on to politics, both local and abroad. There is a question here by Hong. Upon the expiry of the ceasefire MOU between the political parties in Malaysia, how do you see the local market reacting when elections do happen?
I think the ceasefire, is expiring sometime in July, if I'm not wrong. I think if you speak to most of the political analysts, they are calling that there should be an election being called sometime in the third quarter of this year. For stock markets, I think, especially when there's no strong leadership in politics, running up to the election, it tends to be quite muted. People tend to take less risks in case of potential change in government leading to policy changes. But this view is not obviously set in stone. There'll be multiple milestones along the way. There'll be the UMNO election, there'll be the Johor state election. So if all things point towards a strong, let's say, UMNO dominance of the coalition, markets might react ahead of that to price in a strong win and a more business-friendly policy post-election.
David, maybe you can take on this as well. We're still sticking with politics, and it is a big event, as it will be quote unquote election years both in the US and in China. The US midterm elections are going to happen in November, and in China, the 20th National Congress is scheduled to happen in October, which we could see President Xi Jinping cement his leadership possibility for life. And of course, then what will happen with the bilateral relationship between both US and China? Do you feel that tensions could heat up as we head towards election fever? Or it's more of rhetoric? Both of these countries know what they're up to, and they won't move based on the posturing. It's more talk rather than action. How do you think this is going to pan out within, I guess, the number one and number two countries in the world? One could argue which one is number one, number two, by the way.
Okay, as it stands, US is clear number one. To your question, I would like to think it is more rhetoric and just throwing light jabs at each other, but nothing overly significant. Now, on the subject of China's election, everybody thinks, yes, Xi Jinping will cement his third term, he's going to be emperor for life, but he still has to, it's almost a given that he will be re-elected for the third term. But bear in mind, given the policies that he's implemented over the past 8-9 years, he has also made enemies within his party. And over the years, he's been culling them, right? But one just never knows. It's a tail risk. But as it stands, he will be re-elected. But in order for him to get that security of getting re-elected, he has to make sure that the economy is on a sounder footing, right? He has to make sure that people have jobs, they're not losing money, and which is why we think, again, it's a year of transition for China, right? We talk about monetary policy in the US and slower growth, but for China, it's the other way around. Given that the National Congress is in October or November, a lot of these measures have to be he has to start implementing it very soon, because policies take time to flow through to the real economy. So that's what we expect to see. That's what a rational leader or politician would do. But I'm not sure in the case of Xi Jinping whether he thinks the way most people do. But rationally, that's what we would expect to see. And then in the US, look, I think if you look at the history of political leaderships around the world, when things are not going well at home, you always create a bogeyman, right? Somebody to rally the troops around, rally around the flag.
Yeah.
And at the moment, Biden's approval ratings, I just checked earlier, is the lowest. It's, I think, down to about 39%. A lot of complaints regarding his handling of COVID, which I think should subside if Omicron behaves the way we think it's behaving. But the other thing that the American peoples are disgruntled about is high inflation and high cost of living, right? So his approval ratings have come down. So he can approach this in two ways. Look to address this high cost of living, which is why he's putting pressure. The Fed meant to be independent, but definitely there's a lot of political pressure for the Fed to address the issue of high inflation. Or the second thing is to reduce tariffs with China, because US does import a lot of its goods from China, and backtracking and reducing tariffs on Chinese goods would go a long way towards reducing cost pressures. But I think, given where the situation is, given that it's an easy win, and both Democrats and Republicans are unanimous in being anti-China, I think he'll just continue to play to the gallery, but by throwing jabs, not detonating anything. The other issue is,
Let's,
of course, China and Taiwan. I mean, if China is, in my mind, silly enough to be aggressive towards Taiwan, then that could escalate into something else.
Let's spend some time on strategy now. Because of all these crosswinds, where do you think investors can seek shelter for this year, for Asia? What would be some of your sector picks? How are you positioning yourself ahead of all these macro events that are currently happening?
Okay. As a strategy in this kind of an environment, it makes sense to be invested in what we call quality growth companies at reasonable price. Now, quality growth is easy to identify. I mean, there are good companies out there, very strong brands, sticky consumers, what we call companies with a strong moat, right? Their business model is such that, through thick and thin, of course, ups and downs of the economic cycle, but these companies will still be relevant. They produce goods or services which will continue to be consumed by the market. The challenge has been on the second part of that category, quality growth at reasonable price. What is a reasonable price? And reasonable price is dynamic. It's never an absolute. It is largely dependent on the inflation and interest rate outlook, right? If interest rates continue to rise, stays high, or rises further, then the valuation you would ascribe to any company, quality growth or value or whatever, would come down, right? So a lot depends on our view of inflation. I think looking at some of the longer term indicators, inflation remains well anchored. It will be higher than what it was before. We have to accept that. But given the large amounts of debt in the world, the global economy cannot withstand significantly high interest rates. So in the interim, what we're seeing now is an adjustment process where valuations derate. And as this valuations derate, we think it would give us an opportunity to deploy monies by investing in quality growth companies. The other clear beneficiary in some markets, not all, would be banks, right? Because if you assume that the economy is still growing, it's healthy, then higher interest rates leads to higher net interest margins for banks, and therefore banks' profits would increase as well. Apart from that, our strategy has been to reduce expensive growth. I saw on the chat, someone was asking about companies like Nvidia, Amazon. So these are great companies. I think Amazon is not expensive when I look at it on a price to cash flow basis. Nvidia admittedly is expensive, and we made the decision to exit Nvidia, regardless of the fact that it is a great company, and it's a company that we will definitely look to reinvest in. And finally, from a strategy standpoint, given the volatility that we're seeing, given the uncertainty that we're seeing, it also makes sense, and we think it's prudent or judicious to hold slightly more cash than normal. And that's what we've done in our funds, holding more cash, trying to preserve capital as much as we can, trying to minimize losses, but more importantly, providing us with the ammunition to redeploy into the market once things stabilize.
The strategy is quite interesting in terms of holding more cash than you normally would. Is there any markers that you're looking at to a point where you're going to deploy the capital that you have?
Okay, just broadly, of course, we've got
it will
different
be multifactorial. I get that, but yeah, some key indicators.
For some of our funds, it's go anywhere we find opportunities. But of course, the two big markets in the world would be US and China, right? So those would be our main countries of focus or main markets of focus. Some of the names in the US, as an example, Nvidia, if it comes down to attractive levels, it's a name we want to get back into. In China, for example, there could be some reopening plays that we would want to participate in. As you know, China is still very fixated with the zero COVID policies and implementing lockdowns on an ad hoc basis, restricting travel. If this gets reversed, it could be after the Beijing Olympics, or it could be after they come up with their own mRNA vaccine. There would be some opportunities in China as well in that reopening theme space. And similarly, in the US, Omicron, of course, has dented mobility in the short term. But again, there are opportunities that we see in the reopening theme because we talked earlier about inflation subsiding, because we think consumption for goods would normalize, right? Everybody during the lockdown, you have bought your new TV, you have done your home improvements, you have bought your new laptop or handphone or Apple Watch, whatnot. But what is missing? Where is the revenge spending going to turn up in? It's going to be in experiential consumption, and that would be holidays, going to your theme parks, going to cinemas, restaurants. So that applies both in the US and in China, and of course other markets as well. Thailand, for example, could benefit from reopening and the resumption of tourism into Thailand. So any market, but hopefully the right themes.
Still sticking with strategy, but moving to fixed income. Esther, how are you positioning your fixed income portfolios? Do you feel that there are any segments of the bond market that you see value in?
Yeah. So this year, given that we do expect volatility and interest rates to rise, our strategy is to protect capital, at least for the first half of the year, by holding higher level of cash as well as keeping our bond duration low. So as you know, if you buy short-dated bonds, it's less sensitive to interest rates movements compared to a long-dated bonds. So we're staying short duration. Our funds for the Asian portfolios are having a duration of around 3 years. So that will help us to ride through this interest rate cycle. And the higher level of cash will allow us to reinvest into the market when bond yields have become more attractive as well. In terms of segments that we still see some pockets of opportunities, one of the bond market that we like is actually the China government bonds. Because as you know, the rest of the world are going to high interest rates, but we are going to see the Chinese government cutting interest rates, and that is bullish for bonds in the domestic bond market in China. So we have a high weight of 10% into the Chinese domestic bond market, mainly in the government bonds. The other sector that we like, even though I just mentioned earlier that it has been very volatile, is the China property or the high yield market. Because we do think that the correction is overdone, and we still like some of these property developers, especially those that are in the tier 1 and tier 2 cities, where property sales is still decent. Although slowing down, they are likely to recover a lot more stronger compared to the lower tiered cities. And companies that have good access to funding, right? We like companies like Sifi, Powerlong. These are the higher tier, although they are high yield companies, but they are well run and they have financial discipline. So we are going to put more money into some of these names, and we believe they can give double-digit returns for this segment. The other one that we like would be Malaysian credits or corporate bonds, because the corporate bonds market in Malaysia has corrected quite sharply last year, and we can now get good quality names. For example, Dialog at over 4%, compared to, let's say, 1 year ago, they're trading at just low 3%. So those are some of the opportunities that we're going to deploy our capital into.
Still this is my own personal curiosity here. Corporate earnings are going to take a hit, many would assume, as they come to report the earnings for last year, calendar year at least. Is this going to have any bearing or any impact into your views of how you want to think about corporate bonds in Malaysia?
Yeah, so I think in terms of bonds, the things that we look at would be, the gearing, the balance sheet, as well as the cash flow of that company. So no doubt that, if the corporate earnings come in weak, you will see a more challenging environment, and perhaps the company have to also take on more debt. But it depends on the corporate, how they are managing through the cycle, as well as how they are managing their gearing as well. So when we are looking at bonds, the bond yields or the bond market does not react to the earnings as sharply as the stock market. But what bond investors want to see is the financial discipline of the corporate issuer, how much debt or capital structure they are looking at, and the medium-term rating outlook of these companies as well. So I think even throughout the COVID pandemic, I would say that corporate Malaysia, those that are able to issue bonds in Malaysia, although we did see some downgrades, default rates in Malaysia remain very, very low. Right? So I think it is still relatively healthy. Perhaps one of the reasons is because for domestic bonds, we do not really have a high yield segment in Malaysia. Most of the bonds in Malaysia are investment grade and of high quality. So it's not a major concern for us. Yeah.
Absolutely, absolutely. Let's move on to Gan, some strategy that you plan to deploy, not just for Malaysia equities and some of the sectors that you like in Malaysia, but regional equities as well. What would be some of your ideas when it comes to strategy for 2022? Regional equity as well as local equity.
Okay, I'll talk about the domestic equity. I think David can talk about the regional equities. I think for Malaysia, I think we have maybe about 10 to 20% cash holding currently. We are basically playing defense to let the market absorb the change in interest rate expectations, which is still adjusting currently. The rest of the money is invested into banks. We think we can make money in banks this year. If you look at banks, it has very heavy provision in the last 2 years for potential COVID losses. But if you're Malaysian, you realize there is no major bankruptcy, there's no major distress sale, there's no fire sale going on. So a lot of this money that has been provided for over the last 2-3 years will be flowing back into the bank P&L. Malaysian banks as well are very overcapitalized, basically have too much money in the balance sheet. But because of the COVID situation, they can't really pay it out as dividends. If we move away from COVID, as we move towards market opening up, the economy opening up further, these banks all can provide a much higher dividend than what we have seen so far. So banks is an easy space to be invested into, from high risk to low risk banks. The other space we like is actually in the property market, the residential property market and the industrial property market. The residential property market, I think, has been going through 5-6 years of downturn, on a very slow downturn, but last year was actually a very strong year in terms of sales for the affordable segment. We think this trend should continue into 2022, and the stocks are cheap enough. They're trading at 20-30 cents to the dollar. So in terms of the risk for investors to position into property names, is not very high risk. We talked about FDI earlier. I think Malaysia is seeing very strong FDI. As a result, demand for industrial land is very strong. Warehouse rental is going up. So industrial property names should do well this year on continuation of the trend as well. I think the other space we like is obviously technology. I think technology is facing a horrible couple of weeks. But once it has absorbed the interest rate movement, once the bond market absorbed the interest rate movement, we think investors should buy back into the technology names. The valuation might not go back to the same level that it was before, but you can still make money from the strong growth that they are seeing. I think as important as where we want to put our money, where we are avoiding is in the construction names. We have minimum construction stocks for the simple reason that the government just do not have money to spend in a big way to drive the construction sector. The other space we are not buying into yet is the glove names for the simple reason that supply is still more than demand. The adjusting factor basically means your glove prices will continue to fall into probably end of this year or next year. So it's something we're not buying into yet. And lastly, because of potential election in the middle of the year, we will be avoiding politically linked stocks because these tend not to perform because investors are just fearful of any change in personality within the government. That's it.
Fantastic. I'm actually more interested in the things that you're not buying, because generally we want to buy everything, right? But those are the things that you really want to avoid, like the plague. So, okay. Point taken. I was just going through some of the lists that you were talking about, and the names keep on jumping out. I'm talking about the corporate names. I want to ask you a little bit more, Gan, about the impending announcement by Bank Negara on the digital banking licenses. Apparently it's up to 5, but 1 or 2 might have been state actors, so we're really down to 3 to 4 possible open market digital bank licenses. It's going to happen really soon. Some argue that it's going to be happening in February or March. Do you see any investment opportunities here?
I think investors get very excited by the prospects of digital bank license because of what they have seen in Indonesia. I think Indonesia, you've seen some banks go from 1 billion to 10 billion US in market cap within a couple of months. But the story is very different because in Indonesia, I think the unbanked and the underbanked segment is 2-3 times the size of the bank segment. Basically, the bank penetration in Indonesia is very, very low. Whereas in Malaysia, the penetration of banking services is very, very deep, number one. Number two, more importantly, all Malaysian banks, existing Malaysian banks actually can offer digital bank services already. So it's not 5 new banking licenses, it's actually like 20 old banking licenses. So it's not going to change the landscape in a very significant way in the short term. We don't see, there might be some short-term spike if some of the smaller names get banking license, but we don't see much opportunity for genuine investment at this point in time.
Okay. David, the regional equities thoughts and strategy.
I think I shared quite a bit earlier already, Ibrahim.
That's right.
Number one is, as what Gan mentioned, for the Malaysian ports, we're also taking a more defensive posture by holding more cash than normal. What we have sold or reduced our exposure to is in the expensive growth names, some of those tech names, familiar household names listed in the US. We are looking at experiential consumption names, reopening names, companies that would benefit from reopening, especially in China, and some ideas in Thailand and US as well. Banks is the other sector that we have some exposure to as they benefit from rising interest rates. Apart from that, quality growth names comes in various shapes and sizes in various sectors. What we've seen in the H shares market, Chinese companies listed in Hong Kong, we have seen some of these quality names getting sold off to attractive levels, and we have deployed some monies to build out initial positions in some of these companies. So just to share with you what are the qualities that these companies possess. Number one, a name that comes in mind, but I can't share it, would be a Chinese domestic consumer brand. Let's just say it's the equivalent of Nike in China. So it's a name that's at the forefront of Chinese consumers. Stock price has derated. It's not exactly cheap, but it's a lot cheaper than what it used to be. And as consumption recovers in China, we think consumption plus sentiment towards the market in China recovers. We think these would be the go-to names for fund managers. The other one would be a large-scale manufacturer that supplies to global consumer brands. Again, the stock has derated because of concerns over slower growth or slower demand growth around the world. But importantly, there was also a bit of a sell-off because the province in which their largest factory was situated was put in lockdown because of COVID. But that is history. They have reopened. So it's just this concerns over stop-start lockdowns in China that has led to a sell-off in some of these names. Where we will avoid, following on from Gan's pack, is companies that we think would still be at the forefront or focus or target of the government in terms of regulations. As I shared with you earlier, I hope I'm right, I think that the regulatory pressures on the tech sector has peaked. A lot of companies have they're complying already to the best of their ability. So I think for the big tech sector, we are quite comfortable deploying some money back into those names. Some of the other sectors today, there's rumors on education sector, so that got sold down heavily today. Those are names that we would avoid until we get clarity that this regulatory pressures exhaustion has come to pass.
Okay, for final few minutes, let's do a lightning round because I still see some questions pending. What do you think of the zero COVID policy adopted by China? Could that worsen the supply chain? And there's also Winter Olympics coming. I think, David, you can take this.
It is definitely affecting the supply chain. So we were a lot more optimistic about the normalization of the supply chain, end of fourth quarter last year. But given China's continued zero COVID policy, we are seeing some impact on the supply chain. Examples would be port congestion. We are seeing port congestion happening in China. Of course, starting factories and production plants will also lead to disruptions in the supply chain. But on the flip side, remember what I said earlier, I think demand is normalizing. We've gone past the peak period of consumption, which is the holiday season, the Christmas period. So hopefully, while the supply chain disruptions is staying with us for a little bit longer, the normalization of demand and the fact that there is, I think, more inventory today at wholesalers and retailers, that should cap the pressures somewhat.
Okay, Esther, there's a question here on retail bonds or retail sukuk. Do you think that investors should really think about this?
Yeah, I think that's a general question. Definitely the retail bond market in Malaysia is growing, although not as big as the Singapore market. I think the answer would be it depends on what kind of retail bonds, what kind of credit the investor is looking at. Because when you're buying a bond, you're actually buying into a debt. So you need to understand the credit profile of the company. So I can't really advise that, but I would say that get in touch with your salesperson and understand what you're buying into. But I think retail bonds provide you that regular income, right? And you need to look at the credit thoroughly.
And Gan, a question from Hassan. Do you foresee Malaysian bank stocks able to repeat its strong gains in 2022?
I think so. I think if the economy does rebound properly in 2022, the bank stocks are cheap on an absolute and on a relative basis. We think can make money. At the minimum, some of the bank stocks are providing 5-6% dividend yield. So yes, the answer is yes. I think we can make money from bank stocks, and it should have maybe not as a strong a bounce as last year, but it should continue its growth. Bank stocks, as you know, also benefits from rising interest rates, which is what's happening currently.
Sorry, my question to you is this: Karu Saleh has resigned from RHB. Rumor has it that he is going to take the top job at Maybank, replacing Farid. There's also some rumors about some banks consolidating, and of course, target acquisition. Do you think that this is going to take place this year, or do you think that much of this M&A business is going to be put off by Bank Negara towards later on, maybe next year even?
I think to do in-country acquisition for a Malaysian bank to buy another Malaysian bank, we think that will make sense if there's a massive cut in the labor force in the banking staff. because you do not need more branches. You're only buying another bank for the assets. You do not need more bankers because of digitalization. So for most of the Malaysian interbank M&A, it doesn't really make sense unless the government allows them to do a very massive job cut. As you can see, when Axiata tried to merge with DG a couple of years ago, it was a job cut of maybe 1,000+ people, but the government axed that transaction as well.
Yeah.
So it might be a difficult thing to do in an election year. That's what I'm trying to say.
Yeah. Okay. He's currently pursuing ACCA. What are the skills that he needs to acquire?
So my line just went. Is there a question for me?
No, it's an open question. Question from Chandran. What is your advice to aspiring fund managers like himself? He's currently pursuing ACCA. What are the skills that he needs or he should acquire? Anybody can take this.
There's a news article on Bloomberg today that there's no correlation between being a good fund manager and having a CFA, for example.
No correlation.
No correlation. Yeah. I mean,
okay.
if there's a correlation, then your university professor will be the best fund manager. The best advice we can give is to discover what kind of investor you are, and you will only know that from investing regularly in the market. You know whether you're a technical investor, high risk investor, how do you make your money generally. So the process of creating your own portfolio in the stock market, doing your own research and investing regularly, and controlling your greed and fear at the same time is the best learning experience, basically on the job learning experience. And you can do that for quite cheap nowadays because of the small lot sizes and online trading. So that's the best advice we can give to aspiring fund managers.
Okay, 1 minute closing statements. Gan, 1 minute to you.
I
be
think
strong, be brave, be bold for 2022. How about that?
I think there's so much bad news in the market that is the silver lining. That is really a lot of it is almost impossible to find someone that's positive on Malaysia. That in itself is the good news because positioning is low, expectations are low. You just need incremental good news, if it ever comes, to drive the market. That's my 30-second.
Fantastic. It's good. I will remember that. Also, the things that you won't buy, that I'll remember. Esther, some closing statements?
Yeah, I think this year, we have to be patient. We have to ride through the transition year. So as investors, I would advise that, stay invested, but diversify your portfolios, be patient, put in your money gradually, and just stay on, and all the best to everyone.
All right. And then David.
Okay, I think investing is it's a long-term game. You have to be in it for the long term. Don't make the mistake of chasing the latest fads, trying to time the market. You can do it for your own portfolio if you want your excitement in your life, but when you're investing in funds or strategies, it's always best to take a longer term view. But also remember, and I said this many times, it's also making sure that you are sufficiently diversified to ensure that, if there's a screw up somewhere, if markets don't work in your favor, that it is not fatal to your investing journey. So it doesn't derail from your end objective. Yes, it could be a little bit of setback, but it doesn't leave you in a position where you can't put food on the table. So always approach investments with that objective in mind. Don't go all into any single fad or theme.
Thank you very much.
And believe in the magic of compounding. I think either compounding or dollar cost averaging, it does make sense, right? As opposed to trying to.
Is it right that Albert Einstein once said that the strongest force in the universe is compounding interest? I don't know whether that's true or false, but sounds
it's
like
it's attributed to him. But I'm not sure whether he actually said it. But the magic of compounding, of course, it's a given that you must pick the right investments, right?
Okay, fantastic. Ladies and gentlemen, that's the end of our online forum for this evening. We do hope that today's session provided everyone with some valuable insights, which could serve you better in your investment decisions. Again, I would like to thank David Ng, the Deputy MD, as well as the CIO, Esther and Gan Eng Peng, Senior Directors of Fixed Income as well as Equities, respectively. And to everyone, again, we do apologize if we could not ask all of your questions. There were plenty. You can reach out to your wealth and account managers for any questions that you might have regarding your portfolios. And to the members of the public, you can also visit AHAM's website at afinhuangam.com, afinhuangam.com, to book an appointment and reach out to one of their friendly staff. And of course, lastly, we do appreciate if you can complete a survey that should pop up when you exit Zoom. This will help us improve on our future events and will also let you know about other topics that you would like us to cover. Thank you, everyone. Again, take care, stay safe. My name is Ibrahim, and have a good evening to everyone.